Series 4. Now we're going to be looking at investments. Now, what is investing? Investing is a way to potentially increase the amount of money that you have. The goal is to buy financial products, also called investments, and hopefully sell them at a higher price than what you initially paid. Investing is an act of spending money on high-risk products that yield results over a period of time. The investment is usually for a long-term goal, such as buying a house in a retirement village. The differences between saving and investing are: number 1, when you save, you typically put money in a bank account or simply store it in some place safe. When you invest, however, you're purchasing products and keeping your money in a specified investment account. Number 2, when saving, your opportunity for growth is lower and might not exist at all. Investing, on the other hand, helps you beat inflation through interest earned and ensuring your money's purchasing power stays strong. Number 3, saving is usually reserved for short and intermediate term goals, whereas investing is better suited for long-term goals like retirement. You might ask, how does an investment work? The act of investing has the goal of generating income and increasing value over time. An investment can refer to any mechanism used for generating future income. This includes the purchase of bonds, stock, or real estate property, among other examples. Additionally, purchasing a property that can be used to produce goods can be considered an investment. In general, any action that is taken in the hopes of raising future revenue can also be considered an investment. A good example would be when choosing to pursue additional education. The goal is often to increase knowledge and improve skills in the hopes of ultimately producing more income. Because investing is orientated towards the potential for future growth or income, there is always a certain level of risk associated with an investment. An investment may not generate any income or may actually lose value over time. For example, it is also a possibility that you will invest in a company that ends up going bankrupt or a project that fails to materialize. This is the primary way that saving can be differentiated from investing. Saving is accumulating money for future use and entails no risk, whereas investing is the act of leveraging money for a potential future gain, and it entails some level of risk. Number 1, start investing as soon as you can. The more time your money has to work for you, the more opportunity it will have for growth. That's why it's important to start investing as early as possible. Number 2, try to stay invested as long as you can. When you stay invested and don't move in and out of the markets, you could earn money on top of the money you've already earned. That's called compounding returns, and it could mean more money for retirement. Point number 3, spread out your investments to manage risk. Putting all your money in one investment is risky. You could lose money if that investment falls in value. But if you diversify your money across multiple investments, you can lower the risk of losing money. So don't put all your eggs in one basket. There are different types of investments. There's what is called an investment account. Now, these investment accounts offer higher interest rates than a normal savings account. The accounts have a fixed withdrawal date. We've got what are called bonds. Bonds are a type of investing which involves an investment with the government of South Africa, which earns fixed or inflation-linked interest for the term of the investment, such as the South African Retail Savings Bond. When you buy a bond, you're essentially lending money to an entity. Generally, this is a business or a government entity. Companies issue corporate bonds, whereas local governments issue municipal bonds. After the bond matures, that is, if you've held it for a predetermined amount of time, you can earn back the principal you spent on the bond plus a determined rate of interest. The rate of return for the bond is typically much lower than it is for stocks, but bonds also tend to be lower risk. There is some risk involved, of course. The company you buy a bond from could fold or the government could default. Treasury bonds especially, however, are considered a very safe investment. Then we've got shares. Shares are considered a growth investment as they can help the value of your original investment over the medium to long term. These are high risk, fixed or inflation related interest on your terms of investments. Shares are considered a growth investment as they can grow the value of your original amount over the medium to long term. So if you own shares, you may also receive income from dividends, which are effectively a portion of the company's profit paid out to its shareholders. Of course, the value of shares may also fall below the price you paid for them. Prices can be volatile from day to day, and shares are generally best suited to long-term investors who are comfortable withstanding these ups and downs. Then you've got property. Property is also considered a growth investment because the price of houses and other properties can rise substantially over a medium to long-term period. Commodities. Commodities are physical products that you can buy. They could be agricultural products like wheat, barley, corn, or energy products like oil, coal, or solar power. Precious metals like gold and silver are some of the most common commodities. Commodity investing runs the risk that the price of the product will go down quickly. For instance, political actions can greatly change the value of something like oil, while weather can impact the value of agricultural products. Now that you understand investments and different types of investments, speak to your investment team at Sasfin Bank or Sasfin Asset Managers to understand our different offerings for wealth building.